And we head to Kenya now, where the manufacturing sector has been in decline for over a decade. And now it's losing market share in key East African markets. Exports to the country's biggest trading partner, Uganda, fell by about 15% last year. The country's total merchandise exports shrunk by 2.3%. Now, the World Bank says 2016's decline is the latest in a long run of dismal performances. Uganda, for example, imported 25% less malt and starches from Kenya from 2000 to 2015. Now, earlier, CGTN's Ramanyang asked the World Bank's chief economist for Kenya why East Africa's biggest economy is losing market share in her closest trading partners.
If you look at the pace at which Kenya's exports to Uganda are sort of declining, you actually see that you know, it's pretty alarming in that sense. But it's not just Uganda. You can also replicate the story also for some of the
but here's the thing I'm curious about. Is a decline simply because Uganda's buying less in total,
right,
or is it because of import substitution? So the stuff they used to get from Kenya, they're getting from somewhere else?
Yes, it's the latter. When you look at it, actually, we've gone into the product level, and what we do see is that at the product level, or the areas that Kenya was previously competitive and was expanding its exports into the East African market, at the country level or in its trading partners, the volumes are still going up, or it is still purchasing, but the amount that is being purchased from Kenya is going down. And if you look at where this volume is being supplied from, you see that it's coming from across all over the world, which tells that East Africa is a global market in itself, but particularly from Asia. So I think the issue is, you know, it speaks to being competitive, because most countries, if you take the European Union, for example, its greatest trade is with its own partners, within intra-EU trade. I mean, you can also say the same thing for NAFTA, and I think that intra-African trade, even though I would argue that intra-East Africa trade is perhaps much stronger than other parts of the continent, but it suggests that more needs to be done to remove some of the bottlenecks, both trade and non-tariff barriers, to enhance
what's going wrong here? Why is Kenyan manufacturing not as competitive as it should be? Is it mostly because it's harder to get goods across the border? Is it because perhaps the cost of electricity is just way too high? What's going on?
Well, it's a question of competitiveness, and I think some of the investments that the government is doing, particularly on the infrastructure front, should help address. So you did touch on electricity. That's an important element of competition. You did talk about infrastructure. These are all important elements. But there are some issues that can be dealt with domestically, but there are other issues that need to be dealt at the EAC level. For example, mutual recognitions or agreements between different products that are exported within them, so that it reduces the regulatory burden of trading. Because once you add up all those regulatory barriers, it makes you less competitive, and therefore it's easier for those outside the EU to compete, you know, in your neighborhood.